Another evolving storyline that's affecting everything. Maybe is even behind the
new storyline.
Yeah, maybe behind all of the reprieve we've gotten, but definitely in these dollar markets, it's been an evolving correlation between the Treasury market and the U.S. dollar. So let's get into it. What do bonds and U.S. dollars look like together in theory? And this is kind of more of a base case, is that traditionally you'd think rising Treasury yields, so falling bond prices, and the interest rate landscape that plays across the curve, set from the Federal Reserve all the way out to the 30-year, all move pretty similarly. And you'd think rising yields would lead to dollar appreciation because those yields are attractive. That's how the free-flowing bond market works. Once a yield is high enough to be attractive, the bond is purchased, and so that attractiveness leads to kind of flows into dollar-denominated assets.
Right.
And when you're talking about holding dollars in spot FX markets or in other markets, you're actually for holding those dollars, you are generating that yield.
Right.
And that plays through significantly in currency pairs like dollar yen, where the interest rate differential is of a substantial size, and so borrowing one currency at a much lower interest rate overnight and holding the higher yield currency like a US dollar can generate, in theory, some passive returns via the popular carry trade strategy.
Right.
So here on the right, we've got the 3-month correlation between the 10-year note futures and the Japanese yen futures, which you can also in turn interpret as the yield on the 10-year and the dollar yen. Okay. So as the 10-year yield goes up, you're seeing a pretty high correlation to strength in dollar yen.
Very interesting.
So this is the base case, right? Nothing.
And the logic behind the confirmation of the logic behind the correlation.
Right.
That yields play a role in determining currency pair directions.
What's different now? Now we're looking. You've been looking, and yesterday you called out on the show appropriately that we saw a bit of a correlation breakdown with how treasuries were moving and the price action in dollar yen, not really playing out how we thought it.
Right.
How it has been and how maybe you thought it should. But a lot of interesting storylines in the bond market recently, and on the heels of all the macroeconomic conditions, all the trade wars, U.S. assets now kind of were moving similarly together as there was a bigger U.S. risk to all assets like the dollar and the bond market.
Right.
And so that would lead we saw low demand for bonds, and that because the bond prices are directly related to yields, that raises yields, but doesn't necessarily bolster demand for the U.S. dollar, because if there's low demand for bonds, maybe there's low demand for dollar-denominated assets as a whole.
And I think you hit on a lot of great points there. The idea, again, it was rumored the Chinese were, because while ZB, the long end bonds, were getting crushed from 122 to 120 to 118 to 116, 114, 112. Think about that. That's 10 handles. I don't remember the last time bonds have moved 10 handles. Even pandemic-wise, I don't think we moved 10 handles. It was rumored this was the Chinese taking some of their treasury holdings and just sending a message to the U.S. I also heard later in the day it was Japanese pension plans who hold a lot of U.S. bonds. We don't know. It's all
or this
third party.
The basis trade strategy unwinding.
Unwinding, right. It could have, would have. What it was, and while that pounding was taking place, the 2-year notes were actually railing. So this was very specific to one dislocated part of the Treasury yield curve. And when it breaks like that, it doesn't become a useful indicator for us at the
Right.
moment. But the first slide you look at, well, 75% correlation. I want to be all around that
Right.
in terms of helping me to decide on the direction I want to take in dollar yen. Is it your only thing? If yields are up, I'm long dollar yen? No. But if you see the right setup and you get confirmation from the signals you like, either, again, one standard deviation daily moves, U.S. rates, and then this is, again, given Japanese rates really haven't. They're on trajectory higher, but from a very low level.
Right.
So I think this is really interesting stuff, but it does speak to when other things break that market,
Yep.
it becomes a less reliable indicator for us.
And you're absolutely right, because when you take a look at, when you try and wrap your head around what's moving the US dollar, what a complicated question, because you have, as we're looking at on the right, you have all these country-specific pairs that we can weight to get kind of a gauge on dollar strength as a whole. But we have a lot of factors impacting this US dollar. If you zoom out on the macroeconomic landscape right now, you'd think, we're coming off roaring inflation, coming off a lot of growth. So slowing growth would impact kind of the forward-looking outlook on the U.S. economy.
Right.
And that might lead to a slowdown in dollar demand, kind of regardless of what Treasury yields are necessarily doing, because interest rates would be coming down from the Fed. But then you have this trade policy wrinkle where, one, that leads to a lot of country-specific relative strength dynamics, like we saw earlier this year with USD CAD.
Right.
I mean, that has nothing to do with overall dollar strength, because it's just two countries jockeying back and forth on trade, who's going to come out on top. But you also have, this trade policy from the Fed. They're saying could raise inflation. And then what does the Fed do? You get kind of, maybe we get into stagflation. Who knows?
Right.
But not necessarily speaking to rates coming down as quickly. So, all is to say, bond prices and dollar prices, while related, a lot more impacting this dollar than just.
Absolutely. And I think what we're not saying is that, well, Pete, taking away some of the tools you suggest I use. One standard deviation daily ranges aren't working because they're blowing through them. The correlations to treasuries and yen was something that worked. It's not working right now. So what do I do? Sit on the sidelines? Absolutely not. You're mindful that the tools and the things we use to base decisions on all help us determine levels of value, and most importantly, where we get out when we're wrong and where we get out when we're right. That decision doesn't change. What we do is we adjust it in periods when some of the inputs we use are more challenged. It doesn't mean you stop trading. What you do is, again, you get smaller, you stay engaged, look at the entire landscape.
Exactly.
And one of the things that is hard, and I know this from a guy who started and spent his first 5 years just trading one thing, D-marks. I just stood in that pit, traded it every day. And then, because the yen pit was next to me, all of a sudden I was trading some yen. And you get to a point then you're managing a book of 15, 20, 25 underlines. And one of the things that's hard is when you start to expand that, it's all good when everything's moving and normal. But when stuff starts to rip, it's like, oh my God, what do I have on? What's going on?
Exactly.
By staying smaller, you can start that journey of a diversification and start to look at different things with different extremes. There is still so much opportunity out there right now. Just be mindful of again, some of the inputs we've used, yes, they're dynamic in how valuable they are in terms of context, but in terms of movement, we're getting exactly what an FX trader wants, back and forth.
Yep.
How we take advantage of that is up to us and our biases, but there's lots of opportunity, but it never takes us away from where we determine where we get in and where we get out. So keep that in mind, and you're going to be in good shape. It seems like a wild ride. It is a wild ride, but if you keep those contexts, you're going to be along for a great ride. So